what we're going to be going over here is the effect of taxes on cost, volume, profit analysis. And we're going to start by just looking at a graph here to understand this tax effect that would have on this cost, volume, profit analysis. And then we'll move into the equations to support the numbers or the quantities we have on our graph here. So what we have for our graph here to start out with here, we're going to have our units sold on our x-axis here. Just for example, 0 to 300 here. And then along our y-axis, that's going to be our operating income. And then what we have here, we're going to have this profit volume line here. So what we're going to do here to understand what's going on here with this tax effect here, you're going to, when you're talking about taxes, you're going to really have to have a greater profit. That means you're going to have to have sold more units here, and you're going to have a greater operating income to cover the taxes. So let's just start out, and that's the basic concept that we're going to be going over here, and we're going to be calculating those numbers here. But before we get into that, let's just go through our graph here to understand what's going on here so we can go in and do our calculations. Now, okay, so we're going to start, again, we're going to have this profit line here essentially, and what we're going to start out with here is a fixed cost of $2,000. So before we have our operating income, we have at 0 here, but with the fixed cost we're going to start at a negative $2,000 here in our operating income, and then we're going to move up here along this profit line here. So let's understand what that profit line is here. This is the case here. We're going to be using a contribution margin method here to determine our dollars contributed here per unit sold. So this is the case here where you take your selling price, and for example, we're going to have a selling price of $50 here per unit, a variable cost here of $30 per unit. So simply the difference here gives us the contribution margin per unit. So that's what we're working with here. $20 per unit here is our contribution margin. So our profit here, that's simply taking that $20 per unit contribution margin times the quantity or the units sold. That's going to equal our profits here. So that's our profit line. Okay, so we've started here with our negative $2,000 here in operating income due to our fixed cost. We're moving up our profit line here at $20 per unit here. So we're going to get up to a point here where our operating income really equals our cost here, or we have a 0 operating income here. And that is the case. It's just for our example, it's going to be 100 units here. And the only point I want to make is that is our break-even point. And for when we're talking about this tax effect here, we're going to be looking at a targeted net income here versus a targeted operating income. And there will not be any change here in this break-even point here, because there will be no income earned and there's going to be no taxes paid. So that's just the consequence here that we're looking at here when we're going to be making this comparison of targeted net income versus targeted operating income, only to make that point here. So okay, so now we're just moving up our profit line here, and we're going to be looking at the case here where we're going to have $1,400 here in targeted operating income, and this is going to be based on before taxes. Targeting operating income in this case, we're not going to have included any taxes. And then based on, we're going to have for that 1,400 operating income, we're going to have 170 units that are sold. But now we're going to move up the line here, and this is where we're going to be looking at this tax effect here. So what we're doing here, we're going to look at a targeted net income here of $1,400, and we're going to understand that we're going to have a greater operating income here to cover for our targeted net income here of $1,400. We're going to have to generate a greater operating income because of the taxes. So let's just go down and understand this targeted net income here. So again, moving down here, net income, that really equals your operating income here plus any non-operating revenues minus any non-operating expenses, and also minus any taxes. Well, we're not going to really be working with our non-operating revenues and non-operating expenses, but just to understand those would have to be included in any of your calculations here. We're just going to look at the tax effect and understand what's going on, but these other non-operating revenues and non-operating expenses would also have effect here on what your operating income here versus units sold. So let's go back and let's look at what we're looking at here. And for our example here, we're going to have a targeted net income, that's income after taxes, to be $1,400. Same as what we had for our operating income here, where we didn't include any taxes. But as a result of our tax here, we're going to actually have to have a $2,000 here in operating income to support here our net income here, our targeted net income of $1,400, and we'll look at that. And then along with that, we're going to have an increase here in units sold we're going to have a units sold here of $200. So we're going to really be looking at this change here. Without the taxes, well, we had 170. After taxes, 200 units here, so we have a change here of 30 units. And for our operating income, well, without the tax, we'd have 1,400 here, but with the tax, to cover our taxes, our operating income moves up to 2,000 here. So looking at our after-tax basis here, you're going to require an additional $600 in operating income, and you're going to have to sell 30 additional units to pay for those taxes here. That's what we're going to be looking at here. So the other thing you want to look at on this graph here, obviously anything below our operating income line here is a loss. At a zero amount, that's a loss up to 100 units, the break-even point. So anything in this area, we're operating a loss. Anything beyond our break-even here, 100 units, will be operating at a profit, anything in this area. So you see, more units sold, you're going to have a greater profit. Okay, so I guess we've covered everything here. Now we can move into our equations here. Okay, so first let's just look at the case here where we're going to be looking at our targeted operating income here of $1,400, and this is the case where we have no taxes that are paid. So that's just looking at our operating income here where we don't have any taxes. So let's look at how we calculated that target income here of $1,400, and also that 170 units that have to be sold. Okay, so we just go to our general equation here, operating income equation. That's simply our selling price minus our variable cost. That is really the contribution margin on a per unit basis in this case. So the difference between selling price and variable cost, whatever that difference is, you take it times the quantity sold. So then you get that amount here, and then you have to subtract out your fixed cost here, and that's going to equal your operating income. Okay, so for our example here, well, we had that selling price of $50, variable cost here $30 per unit, times, in this case, we have 170 units sold. So you subtract 2,000 here or that fixed cost here, 2,000. That's going to give you your operating targeted income here, $1,400. And then remember, that's just this 50 minus 30 is just your contribution margin times 170 minus 2,000. That gives you your $1,400. So for our quantity sold, again, we base it on this, we calculate it here based on our contribution margin per unit. So here you got that would be your fixed cost here plus your operating income divided by the contribution margin per unit. So we had the fixed cost here, 2,000, plus our 1,400 in our operating income here, divided by that contribution margin here at $20 per unit. That gives us our quantity here that we have to sell here of 170 units here to have our targeted operating income here of $1,400 here, and this is worth no taxes. Now let's move over here and let's look at the case here where we're going to have that targeted income here of $1,400, but it's going to be $1,400 in net income here. So this operating income. So the question is, what operating income here do you need to support the $1,400 here in net income? Same equation here as we had, selling price minus variable cost. That's our operating income equation here. Again, selling price minus variable cost times the quantity sold. That would be less our fixed cost. And then now we have to do same equation as we did here before the taxes, just to point out that. So now now we're going to move down. Okay, you got to understand what the contribution margin is here. Selling price minus variable cost. We're going to be using that. Now, this is the case where we're going to be looking at our targeted net income here and our income taxes. Again, the question is, what operating income and quantity sold do we need to meet that targeted net income here of $1,400? So remember, the net income here is the income after taxes. So these are the equations you have to be going through here. So your targeted net income here, again after taxes, that is going to really be equal to your targeted operating income, and then you have to subtract out those taxes, and the taxes here are really your whatever you have on your targeted operating income, if you got any income here, times whatever the tax rate is. So simply targeted net income is your targeted operating income, and then subtract out whatever taxes you're paying. So you're paying taxes here on that operating income times whatever tax rate is. Okay, so now we can rearrange, really factor out this targeting net operating income here to come up with the equation here where your targeted net income here, that's your after-tax amount here. Again, factoring out your target in your equation here, you're targeting operating income amount here. So factor that out, your targeting operating income times 1 minus the tax rate. So just that's all we're doing here is factoring out that equation, just so you understand what's going on. And then for our example here, we're going to be using 30% here as our tax rate. So now we can rearrange this equation here. We can just isolate our targeted operating income here on this side of the equation. That means you're going to have to take 1 minus your tax rate and divide it into your targeted net income here. That's all we're doing here, just rearranging or just isolating your targeting operating income on this side of the equation. So that's 1 minus your tax rate divided into your targeted net income. Again, that gives you your targeted net income here. And remember, the net income here is after your taxes, 1 minus your tax rate. Just rearrange the equation. So now we can determine what our targeted operating income is. That's that number that we talked about here, that $2,000. That's simply your targeted net income. Remember, we targeted that to be $1,400. The same as operating income without taxes. We're just doing it for the comparison. You can put any number you want in here to make do your deal, but we're using that $1,400 amount. So now you divide that 1 minus the tax rate. So 1 minus your tax rate here, 30%, or 0.7 or 70% here, divided into 1,400. That gives you your $2,000 here. So now to determine our quantity required that we have to sell here, a number that we have to sell here to generate that that targeted operating income here at $2,000, or our targeted net income here at $1,400, however you want to look at it. Simply using our contribution margin per unit method here. That would be our fixed again, quantity required to sell. That would be our fixed cost divided by our targeted operating income, or fixed cost, plus our targeted operating income here. That's what you'd normally use here in your contribution margin. You'd have that operating income here. But we know our operating income, we defined it here as our targeted net income minus 1 minus the tax rate, that amount. So again here, you take your fixed cost plus your targeted net income divided by 1 minus your tax rate here. Then you divide that by your contribution margin per unit. And here we're going to come up with that quantity required to sell here at $200. So fixed cost was at $2,000 amount, plus our targeted net income, or our targeted operating income here. What we substituted in here for our targeted operating income, the targeted net income minus 1 here. That was what? Well, whatever it was here. Then you would use that amount here. In this case, it is the targeted operating income here of $2,000 here. But you could substitute that in here. Just go with your targeted net income, 1 minus your tax rate here. Put that in here. Then divide it by your contribution margin per unit. So again, what do we have here? That was quantity here of 200 equals the 2,000 here in fixed cost plus that targeted operating income. Didn't want to confuse it here. Either of those two amounts, they should be equal the way we've got our equation set up, plus the 2,000 here, divided by contribution margin per unit here, $20 per unit. That gives us here 4,000 divided by $20 per unit should give us 200 units here that we have to sell. Okay, so just going back down here, just to understand this quantity required to sell here using this contribution method, contribution margin method. We could have done it in other ways, but I'm just going through this method. So again, that was our fixed cost plus our operating income. But remember our operating income here, we redefined it here, or it was a targeted net income divided by 1 minus the tax rate. Again, divided by the contribution margin per method here. So our contribution margin per unit, excuse me, was just that $50 minus our $30 for $20 per unit. Okay, so maybe we should just go through the equations one more time here. Didn't want to confuse it too much here, but remember when we talked about that targeted operating income, that came off our equation up here, where that was the targeting operating income equals your targeted net income divided by 1 minus your tax rate. And that's what we substituted in here to determine our quantity required to sell. Just to redefine it, that was a fixed cost here plus our targeted operating income, which is really the targeted equals our targeted net income divided by 1 minus the tax rate divided by your contribution margin here per unit. Okay, so maybe let's go back and let's look at that graph one more time here. So we went through our equations here and we supported all our numbers here. And what we were looking at here, we calculated here on a before tax basis here. We had a specific profit here before tax. That was simply, in this case, what was 170 units here times $20 per unit here. That gave us that operating income here of $1,400. So that was our before tax amount here. And because of those taxes here, with that 30% tax rate, we actually had to increase our profit that were generated here. We had to increase our units sold here. And based on that, we'd have to have a greater operating income here. And you could see what we went on here. So we went in our units sold, we went up from 170 to 200 units, or increase here of 30 units here. This was on an after-tax basis. The required additional amount that we had to sell here. 30 units here because of that tax rate. And then for our operating income, remember our targeted net income here was still $1,400. We wanted to save it, be the same here as our operating income before taxes. I just threw that number out here. But in order to generate a targeted net income here of $1,400, we had to have that additional operating income here from $1,400 up to $2,000 here. So we needed an additional $600 here in operating income, the required additional amount that we need. So just understanding what's going on here. When you take those taxes into consideration, you have to sell a greater number of units here. You got to make a greater number. You got to earn. You got to have a greater operating income here to support any taxes. So we looked at a before tax basis and an after tax basis. And just for this cost volume profit graph here, remember we did go over that break-even point here, and any units that are sold here, if you sell less than the break-even point here, you're going to generate a loss. Any units sold greater than the break-even point, you're going to generate a profit. But just remember here, when you start out with those fixed costs here, you'll have greater losses. The more units you sell here, you're going to narrow those losses down to the point where your costs equal your profits here, or your revenues, whatever, and that you're going to have a zero amount here. You're going to have a zero operating income, but you're going to have to sell so many units here for the zero operating income. In this case, it was 100 units. And then as you move up the line here, the idea is here, the more units you sell, the greater operating income you're going to have, the greater profit you're going to have. But with the tax effect, you're going to have to increase your profits, and therefore you're going to have to increase the units sold and generate greater operating income. Okay, so that'll summarize our topic here when we talked about our effect of taxes here on our cost volume profit analysis.